Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Hope you're having a great day here today. Hope you'll check us out at jazzwealth.com. We're financial advisors. We manage your investments, help with your personal and other finances and other investments as well. And really, we teach every week. Just try to teach you more and more. We call it the dojo. It's sort of our own little private financial Netflixy looking thing where all of our previous classes are loaded in there. And then every Thursday live, it comes to life and I show up and I teach you something a little bit new in more detail that maybe you didn't know before. We've got a lot of good classes in there as of late. Well, today I want to teach you about your 401k. So for a lot of you, your 401k is going to be the biggest asset you have, right? Maybe your house is the biggest. This will be the second biggest. Depends on how much you put in your 401k. Give it enough time and it could be by far the biggest asset that you have. So it's sad that a lot of the choices that you have in there are limited. Why would the biggest investment vehicle that you have be limited? It's not really fair, right? Well, it's actually good lobbying that keeps it that way because you would think there'd be stocks and ETFs all available in there, but no, sadly, most of the time it's just mutual funds and often they're sort of mediocre choices. They're not really all that great. You go, well, hey, Dustin, I got a target date fund in there, so I'm doing just fine. Really? So target date funds these days are taking more risk than almost ever in history. You got to go back about a year and a half to find the peak moment where they were taking more risk than they should. Why? Not because they're bad people, but because they have to. See, in a target date fund, they've got to generate an expected return over a set amount of time. And since bonds are typically a go-to vehicle there, well, bonds are sort of yielding next to nothing at the moment. And so they can't get the growth unless they expose themselves to the stock market. So between you passive investors that are just buying index funds and the target date funds that have to keep putting more and more money into the market as interest rates go lower, it generates a certain amount of risk. And right now, you don't care. You're like, whatever. The markets are going higher. It doesn't matter to me. But if you go back far enough to like 2008, 9, right in that area, the old saying was, my 401k became a 201k. That was like the joke going around there because the markets fell so hard. Well, when the markets do fall, you might think, it's not that big of a deal. But I can tell you from experience, when the markets fall, the phone rings more here than ever. People go, oh my God, what do I do? And I go, well, you said you were just going to invest in a target date fund and you're good. And they go, yeah, I know, but there's got to be something better. You didn't care a couple months ago, but now when the markets fall, all of a sudden you care. And it's a natural thing. I'm not picking on you, but every other advisor has a sales pitch that's ready for that. I don't do that, right? I just try to give you the best advice I could. If you're going to work with us here at Jazz, great. If not, I'll help send you on your way, hopefully with a little bit of comfort. Now, some 401ks will offer, they call it like a brokerage link at like Fidelity. They'll call it an option account, which is not options. It's the option to choose stocks and things like that. But sadly, you have to pay commissions. They're not free, right? And although mutual funds are not free either, they're going to get their money. It's just not fair, right? If every time you get paid, you had 3 exchange-traded funds or 3 stocks that you had to pay $6.95 or $5.95 or whatever, then every couple weeks when you get paid, that's like $15. It's just gone. $20 just out the window because you want to have different investments. That's not fair either. I don't really think that's very fair. And I haven't seen one yet where they say, go ahead, buy all the stocks and ETFs that you want and there's no cost. We have no cost here in our funds, but that's just because we choose to do it that way. So sadly, that's not an option in there. Now, if you feel the same way about your 401k and you go, I don't have a lot of choices. I don't like what I have. What I have isn't working for me. It's not getting me towards my goal. There's typically a lot of growth options in there, but not a lot of conservative options. So the people that get closer to retirement tend to go, holy cow, I can't take that much risk, but I'm not given any other choices. Well, if you don't like that, there's something called an in-service rollover. You have to say it that way. That's the only way they will even acknowledge that this exists. You have to say, can I do an in-service rollover? See, what that means is while you're still working at the company, you're able to roll over the account. We all know that when you leave your job, you roll over your 401k either to your new 401k or to an IRA, and most people will suggest that you put it in an IRA so that you have more choices. You're not limited anymore. You can do whatever you want, almost. But so that's typically the case. Well, you can sometimes get away with doing this while you still work at the job. You can call up your 401k plan provider and say, I have X number of dollars in my 401k. I am still employed with this employer. I'd like to know if a in-service rollover is an option for me. If it is, I promise you they're going to try to start selling you on the IRA and get you to open one of those with them so that you end up paying the $5.95 per trade. But don't do it. There's a lot of other choices and, sort of sneakily, I hope you'll choose us. But anyways, I wanted to point that out to you. Now, The only real time I've seen this successfully done is when the company doesn't offer a match. So if the company was offering like a 3% match, a 4% match, and then something happened and they took it away and they said, we are no longer going to offer a match, that's typically when the in-service rollover option clicks on. If that's the case, that may be your chance to take that money and put it in something that you've always wanted to put it into. Maybe you want to be more aggressive, or you're a stock picker, or you like the index funds, whatever it may be, that may be your chance to do it. The other option would be if they offer a match, the only way I've seen them allow an in-service rollover is if you stop your contributions, which means the company stops their match, which then gives you the option to roll it over, which in that case, you still have the 401k. You can just turn it right back on after that, build it up again, and then roll it over again next year or whatever, however long it takes you. So just something to consider. It's not suitable for everybody, of course. It's just an option that I want you to know is out there for you. I certainly hope you'll keep us in mind. Naturally, that's why I'm here if you decide to do something like that. But really, for anything that I can help you with investment-wise, if you have a Roth IRA or accounts that you're managing, you're just not quite sure how to get the help, or you want a more detailed personal sort of help with the rest of your finances, of course, I'm happy to help you. And I hope you'll check us out on our website, of course, jazzwealth.com. We'll also be back later, 5 o'clock Eastern time. We do a live show every day to talk about the stock markets, give you all the geeky stats that wrap around that. It's Jazz Wealth Managers on our YouTube channel and also on Roku, Investors Business Network, live at 5 o'clock. I hope you'll check it out. In the meantime, enjoy the rest of your day. Thanks for watching.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.